In early 2026, geopolitical tensions involving the US, Israel, and Iran rapidly escalated into direct military strikes across the Middle East. The regional conflict sent an immediate shockwave through global markets, and Dubai, the financial hub of the region, was caught right in the crosshairs. This chart shows the Dubai Financial Market Real Estate Index from February to March that year. You can see the panic in real time. It wiped out months of steady gains and left stock investors scrambling for the exits. In just 2 weeks, the index plunged 34%. But look what happens when we overlay the physical housing market. While the stock index collapsed, the Dubai Land Department recorded nearly 12 billion dirhams in actual physical property transactions. Buyers weren't running away. In fact, property viewing activity spiked by 75%. Physical home prices experienced a negligible dip of somewhere between 4 and 7%, before rapidly bouncing right back to their previous levels. How can a city's real estate stock index suffer a catastrophic collapse while its actual physical housing market simultaneously expands? To understand the decoupling, we have to define what the Dubai Stock Index actually measures. It does not track the value of a villa in Dubai Hills. It tracks the equity valuation, corporate health, and debt ratios of a few large publicly listed development companies. This flowchart illustrates how institutional capital moves during a crisis. Developer stocks are highly liquid assets. When a geopolitical shock hits, international funds instantly sell off those liquid shares, draining out local developer equity to cover their losses in other globally panicking markets. The sell-off has almost nothing to do with local housing demand. Physical real estate operates on entirely different physics. You cannot day trade an apartment building. Illiquid property is anchored by human utility. People need a place to live, work, and send their kids to school. It moves based on long-term residency, not algorithmic trading triggers. And the long-term residency data in Dubai is staggering. The city is currently absorbing an average of 470 new residents every single day. That is a persistent structural baseline of human demand that requires physical keys and physical doors. Combine that with the safe haven effect. Historically, regional instability acts as a powerful catalyst for Dubai. When neighboring countries experience conflict or economic sanctions, ultra-wealthy foreign capital flees those zones and parks itself directly into Dubai real estate. Equating a volatile stock ticker with the value of a physical home is a category error. It causes investors to misprice their risk by ignoring the tangible floor underneath the bricks. Physical property values in 2026 are moving according to a different set of forces. In February, the government eliminated the 50% upfront cash requirement for the 10-year golden visa. Because mortgaged properties now qualify for residency, the rule change expanded the buyer pool by 50%. But these buyers face a new dynamic, the supply pipeline. Approximately 120,000 new units are scheduled to hit the market. Broad financial indices cannot account for geographic scarcity. Look at the Palm Jumeirah. There is a finite amount of coastal land available to build on. You cannot replicate this geography, meaning supply in these premium microeconomies is effectively zero. Because of this scarcity, the supply wave acts surgically. Abundant mid-market apartments located in the desert suburbs will see their rental yields flatten as tenants gain more options. But luxury assets in prime locations remain heavily insulated from those price corrections. Physical real estate value in Dubai is governed by these two forces: the absolute scarcity of premium land and government policy that dictates who gets to live there. A stock market ticker is blind to both of them. We have seen stock markets and housing markets crash together before. During the 2008 global financial crisis, both developer equities and physical property collapsed by about 40%. But 2008 was a market built almost entirely on rampant, unchecked speculation. Since then, regulators have institutionalized the system. They introduced mandatory escrow accounts, meaning developers can't use buyer funds as a blank check. The fragility that defined the previous era has been systematically stripped out of the legal framework. Today, the physical market is anchored by gross residential yields averaging 6.8%. Investors are holding on to assets to collect highly competitive, recurring rental income, rather than trying to flip off-plan contracts for a quick margin. When you combine tight regulatory oversight, a steady influx of end users, and high rental yields, you get a mature, unshakable structural foundation. The stock market can whip up a storm of panic, but the underlying asset refuses to move. Liquid equities will always react to the latest global headline, but physical wealth in this city is firmly anchored in the official deeds, the growing demographics, and the tangible human demand.